So, Brian, it's been great having you with us again in Hamburg. And I very much enjoyed the day of meetings we had. And we thought, why not recap some of the questions that came up from investors and see what perspective you can share that's relevant to our wider audience.
Sure.
So one thing that the media, especially here in Germany, likes to portray, and I'm very curious for your take, is that the buyout model, given that it's leverage buyout, is now supposedly broken just because there's been a raise in interest rates. You've looked at this for over 20 years. You must have seen this before. What's your take on it? Is buyout broken?
No, buyout's not broken. Interest rates go up and down. We've been in a low interest rate environment for a long time. People have gotten used to that. Leverage is important to our model. It's not the defining attribute of our success. We tend to do modest leverage. We operate in the middle market, lower middle market. You tend to see leverage multiples, 5 times plus or minus. We work with relationship lenders who are very fair and reasonable, and we tend to have, 1 or 2 covenants: interest rate coverage, interest expense coverage, I should say, fixed charge coverage. And when we invest in a deal, we make sure that there's a lot of cushion in those covenants. And so we can absorb interest rate increases. And we have. Things have gone, pretty well over the last 6 to 9 months as these rates have gone up a lot. But it does affect the financials. There's no question about it.
And we probably haven't yet hit a level of rates that you haven't seen working in the past historically, right? I mean, it feels like someone took away the punch bowl, but still we're not yet at excessive levels that would prohibit the model from working.
Oh, definitely not. No, I've been doing this multiple decades at this point, and we've seen all interest rates. I'm old enough to know that if you go back to the late 70s, early 80s, interest rates well into the double digits were very common in the United States. We're nowhere near that. These are very close to historical norms. So, and we've been in this business so long that we knew interest rates were going to go up over our hold periods. And all the sponsors we work with know this. So it's factored into everything we do, all the modeling, all of it. We think about contingencies and what could happen over the next 3 to 5 years.
And then the space that you, as do we, focus on, the small and mid-cap space, is typically characterized by lower levels of leverage anyway, right? Which comes as a cushion on top of, the high-quality business models that we tend to invest in.
Right. On a relative basis, in the middle market, lower middle market, small market where we play, you have lower purchase price multiples, lower leverage multiples. And we're not working in syndicated loans. We're working with relationship lenders, a couple covenants, interest coverage and fixed charge coverage and modest amortization. There's almost always very modest amortization in the first few years of a deal, which helps to get your bearings and get things off to a very solid footing.
I find it counterintuitive then that people say, well, the small and mid-cap space, for us, it feels maybe too risky. So rather than investing through a diversified portfolio of smaller funds, we take the safe route and go with a single mega-cap name. Have you heard that before? How do you react?
Certainly we have. And there are a lot of great mega-cap names, but that's a single fund. We're a diversified fund of funds and co-investor. So you get a very well-constructed vehicle over time, industry, geography, etc. But the middle market buyout space has been around a long time. The best returns exist in the middle market in North America. It's a consistently investable place where there is modest risk of loss, but there's dynamic upside that can really define a portfolio. And we think the smartest minds chase the middle market in North America.
People who are new to investing into private markets, into private equity, oftentimes shy away from the longer tying up of capital, let's say, and find the public market to be a comparable and more attractive alternative to getting equity exposure in the US. But the stock market is characterized by just a handful of very dominant names these days. How how would you characterize, say, the opportunity set in the wider private market, especially in our segment of the market, versus the liquid investable alternatives that people have these days?
Sure, there's always a place for public equity. That's a cornerstone and should be of everyone's portfolio. As you allude to, over the last year or two, it's the top 7 technology names that have really been defining the success of the S&P 500. The other 493 names are doing okay. The entire point of private equity, of course, is to outperform the public markets. If it's done well, you can outperform by hundreds of basis points. There's illiquidity, but once you get a program underway and you commit to it and you build your exposure, and as you get distributions back, you continue to reinvest and build your exposure, the illiquidity is not much of an issue. So we believe strongly, of course, in private equity because when it's done well, the outperformance against the public markets is substantial.
And is now the right time to invest? Because, people sometimes wonder if they can time private markets, and they look at the environment. Some asset classes are struggling, there is uncertainty on many fronts, and people think, but how about we hold out and try to get a better entry timing? Does that make sense at all?
Absolutely, people can think like that. But the most important thing in investing is doing it consistently, having a target, going after the target, and then evolving and iterating based on your institution or individual needs. So we think now is a great time to invest because private equity, the way we do it, is we're always trying to get to good companies and make them great. Great companies make them excellent. It's very driven by operational improvements. It's very driven by acquisitions and organic growth and making something much bigger, much better. And that transcends the markets. So if you invest in private equity, you have to absorb the illiquidity, but you have to do it consistently and you have to do it resolutely.
Excellent. So let's do it.
Absolutely. I'm with you.
Thanks, Brian.
Thanks, Oscar.